The opening bell rings at 9:30 a.m. Eastern Standard Time, but smart money, we get there early. Welcome to Beat the Bell, the podcast that demystifies what's happening in the market before it impacts your wallet. I'm Dominique, Broadway, self-made first-generation multimillionaire, and after helping over 600,000 people build wealth, especially those who are the first in their family to do it, I'm here to translate the financial noise into clarity you can actually use. Whether you're just starting your wealth journey or you're ready to level up, this is where we beat the bell together. Hey, beautiful humans, and welcome back to Beat the Bell. I'm Dominique Broadway, and if you're sipping your morning coffee or your afternoon latte right now, wondering if the financial world has lost its mind this week, then trust me, you are not alone. This week gave us the Fed's first rate cut of 2025. But here's what no one's telling you. While your credit card interest rate might drop a tiny bit, the real story is what this signals about where our economy is headed. And with fresh inflation data dropping literally as we speak, the next 15 minutes are about to change how you think about your money for the rest of the year. So grab that coffee or your cocktail, settle in, and let's demystify what this week's financial roller coaster actually means for your wallet, your investments, and most importantly, your peace of mind. Because when the headlines are confusing, we're here to make it crystal clear. All right, let's start with Wednesday's big moment that had everyone talking. The Federal Reserve cut interest rates by 0.25%, bringing them down to 4.0 to 4.25%, right? So that happened last week. Now, if your first thought was finally some relief on my debt, I need you to pump the brakes for a second. So here's the real tea. Fed Chair Powell called this a risk management cut. And basically, when the Fed starts using phrases like that, they're basically saying, we're worried, but we don't want y'all to panic. The vote was close, 10-9, which tells me this committee is far from united on where we're going. So what this actually means for your money right now. First, if you're carrying variable rate debt, credit cards, HELOCs, some personal loans, you'll see some relief over the next few weeks. We're talking maybe $10 to $15 less per month on a $5,000 credit card balance. No, it's not life-changing money, but every dollar back in your pocket counts. Second, if this is where I need your full attention, that high yield savings account that's been paying you over 4%, it's about to start dropping. Money market funds are going to follow suit over the next month. And if you've been living off those interest payments or just enjoying watching your savings grow, it's time to get strategic. So the labor market reality that nobody is actually talking about. But here's where it gets concerning and why Powell looked more worried than relieved during that press conference. We just found out that the economy created nearly 1 million fewer jobs than initially reported over the past year. Let me repeat that. 1 million fewer jobs than we thought existed. Think about that for a minute. We've been celebrating job growth that was basically a mirage. August saw only 22,000 new jobs created. That's barely a blip for an economy our size. Powell said the labor market is softening and we don't need it to soften anymore. Translation, they're trying to land this economic plane smoothly, but it's coming down faster than expected. So your action steps right here, right now. If you're employed and thinking about job hopping, I need you to be extra strategic. Have that next opportunity locked down before you make any moves. If you're job hunting, build in extra time and be prepared for a more competitive landscape. And if you're considering a major purchase that depends on steady income, like buying a house or that new car, factor in some extra financial cushion. So this isn't doom or gloom. This is just smart money management when the economic signals are mixed. Now, let's talk about what happened in earnings this week, because these stories tell us everything about how companies are really handling this economic environment. And trust me, there are some lessons here that will change how you think about your money. First, we have CarMax. When tariffs hit that wallet, okay? So the biggest shock this week was CarMax, which absolutely tanked on Thursday, dropping over 20% after completely missing earnings expectations. They were supposed to make $1.05 per share and they delivered just 64 cents. Revenue, they missed by $400 million. But here's what you need to understand. CarMax's CEO talked about rapid depreciation in used car values. So some vehicles lost $1,000 in values in just 1 month during the quarter. This isn't just bad business. This is tariffs economics playing out in real time. Earlier this year, people rushed to buy cars ahead of anticipated tariffs, driving prices up. Now that demand has cooled, those inflated values are crashing back down. And the personal finance lesson is if you are holding any major depreciating assets, cars, boats, RVs, this market is getting more volatile, not less. Now, Costco, the power of value and loyalty. So Costco reported yesterday and beat expectations with $5.87 per share in earnings. Their same store sales grew 6.4%, but here's the number that made me smile. Membership fees income jumped 14%. Y'all, this tells you everything about consumer behavior right now. When money gets tight, people don't just shop around. They gravitate toward brands they can trust that deliver consistent value. Costco sold 245 million hot dog combos this year at that same $1.50 price that they've had since 1985. That's the year I was born. That's nostalgia. That's a recession-resistant business model. So for your investment strategy, this is gold. Look for companies with pricing power and customer loyalty that runs deep. When the economy gets shaky, those are the businesses that not only survive, but thrive. Now, Pfizer's big bet on weight loss. The deal that had everybody talking was Pfizer's $4.9 billion acquisition of Metsera, potentially worth $7.3 billion with milestone payments. Pfizer is essentially admitting they missed the obesity drug boom, while Eli Lilly and Novo Nordisk created a market heading toward $100 billion by 2030. Metsera's drugs offer monthly injections instead of weekly ones, which could be a game changer for patient compliance. For us as investors, this shows us how quickly Big Pharma will pay premium prices to catch up on trends that are missed. So your portfolio takeaway, these earnings paint a picture of bifurcation. And I need you to understand this word because it's going to define the next year. Some companies are thriving by doubling down on value and customer loyalty like Costco. Others are struggling with commodity pricing and economic sensitivity like CarMax. And some are paying big money to chase opportunities that they miss like Pfizer. When you're building your portfolio or just deciding where to put your money, ask yourself, does this company have pricing power? Do customers choose them even when money's tight? Can they control their own destiny? Those are the businesses that create wealth over time. So, speaking of economic cross currents, as we're recording this Friday morning, we're getting August personal consumption expenditures data, the Fed's preferred way to measure inflation. So economists expect core PCE around 2.9% annually, still well above that 2% target. So your action items remain the same. Audit those subscription services because companies are getting bolder about price increases. Time major purchases strategically. Anything with imported components is likely getting more expensive through 2026. And make sure your investment strategy includes some inflation hedges because this environment isn't ending anytime soon. As we head into October, I need you prepared for what's coming next because the financial calendar is packed with events that could reshape your investment strategy and your money moves. So the Fed has 2 more meetings this year, and their own projections suggest another half point of cuts coming. But here's what they're not telling you in those fancy dot plots. Those projections assumed inflation would be cooperating by now. With today's PCE data likely showing stubborn price pressures, don't bet your rent money on those additional cuts happening. So third quarter earnings are start rolling in next week. And this is where we'll see who's been really managing through high labor costs and persistent inflation. So companies have been remarkably good at protecting their margins, but something's got to give. So watch for guidance cuts, especially from consumer-facing companies, and pay attention to what management teams say about pricing power. That's going to separate the winners from the losers in 2026. So we also have this inflation factor. So with presidential politics heating up, the markets are starting to price in policy uncertainty. I don't want you making investment decisions based on political noise, but I do want you recognizing that volatility is coming. So make sure you've got 3 to 6 months of expenses in cash, because the best buying opportunities often come when you least expect them. And remember, volatility creates wealth transfer, not wealth destruction. Be ready to act when others are panicking, okay? Now, Europe's dealing with their own economic challenges. China's real estate market continues to create global headaches, and currency movements are getting more dramatic. So if you're internationally diversified, which you absolutely should be, expect continued choppiness. But here's the thing. Global diversification isn't about avoiding volatility. It's about positioning yourself to benefit from opportunities wherever they rise. Now, for this week's Beat the Bell Challenge, I'm calling it the hashtag Fed Rate Challenge, because I want you to get real about how this week's rate cut actually affects your money. So here's your homework. First, pull out every piece of variable rate debt you have. Credit cards, HELOCs, adjustable rate mortgages, all of it. Take each balance and multiply it by 0.0025. That's your annual savings rate from this quarter point cut. Divide by 12 for your monthly impact. Next, do the same calculation for your savings. High yield accounts, money market funds, short-term CDs coming due, same math. But this time it's income you're losing. But here's where it gets interesting. I don't want to know who saves the most money. I want to see your most creative strategy for dealing with the net effect. Maybe you're moving money from your savings to pay down debt faster. Maybe you're finally opening that iBond account. Maybe you're locking in CD rates that drop further, right? So share your strategy with me, tag me, Dominique Broadway, and let me know what your strategy is. I'll also feature the most practical ideas in Monday's episode, and the smartest submission can get something from me. All right. So remember, small changes compound over time. 0.25% might not seem like much today, but over years, it adds up to real money, either working for you or against you. And let's make sure that it's working for you. All right, beautiful humans, let's lock in the 3 things you absolutely cannot forget from this week. So the first one is that the Fed is walking a tightrope and they might fall. This rate cut isn't a victory lap. It's honestly a warning shot. They're trying to support a weakening job market without making inflation worse. So your move, prepare for either outcome. Keep cash ready if unemployment spikes, and creates buying opportunities, and keep inflation hedges if price pressures persist. Don't pick sides. Get ready for both scenarios, okay? Number 2, the high yield savings party is winding down. Those 4% plus savings rates were nice while they lasted, but the music's stopping, okay? If you've been parking money for the perfect investment moment, decision time is here, okay? Number 3, the labor market weakness changes everything. 1 million fewer jobs than we thought existed. That's not a footnote. That's a fundamental shift in how you should think about employment risk. So build bigger emergency funds, be more strategic about career moves, invest in recession-proof skills. The job market just got way more competitive. So the bottom line is that we are in a transitional moment where the easy money era is ending, but we don't yet know what's replacing it. Your advantage lies in preparing for multiple scenarios instead of betting everything on one outcome. That's not fear-based thinking. That's wealth-building thinking. So before you start your weekend, I need 2 things from you, and both will make you money. First, take the hashtag Fed Rate Challenge seriously. 5 minutes of honest calculation can save you hundreds over the next year. More importantly, share your strategies with our community. We build wealth together, not in isolation. Second, if this episode helped you see through the financial noise to what actually matters, share it with someone who needs clarity. Beat the Bell works because we focus on actionable insights that help real people make real money moves. So Monday's episode will preview the week ahead, including earnings season kickoff and key economic data that could signal whether this rate cut was perfectly timed or too little too late. I'm Dominique Broadway, and remember, in volatile markets, knowledge isn't just power, it's profit. We'll see you Monday morning when we beat the bell together.